Beautiful. So hello, everybody. Good afternoon, and welcome to the very first session of our monthly Astor Glassdoor portfolio review. My name is Laura Nieves. I'm head of investor relations here at Astor Realty Capital. I've worked for Astor for going on 10 years. I am the main point of contact for all of our current 300 plus investor base network to date. And many of you know me, but to those who don't, hopefully one day soon you will join our investor family and we will get to know each other very, very well. So before I dive in, as many of you know, transparency is one of the core values at Astor, and we're thrilled to launch this new initiative to provide our investors with a clear, comprehensive look into our current real estate portfolio. This series is designed to give both existing and new investors a deep dive into our $2.5 billion portfolio, shedding light on our performance, strategies, and market positioning. Our goal with these monthly sessions is simple: to foster trust and confidence by offering a transparent view of how your investments are managed, especially in today's dynamic market conditions. We want to keep all of our investors informed, engaged, and rest assured about the steps that we take every day to preserve and secure your capital. So before I dive in, I am going to introduce the driving force behind Astor Realty Capital. Astor, under the leadership of Joe Burko, has risen to the prominence of a current participator of a phenomenal $2.5 billion real estate portfolio that spans across 12 major US markets. Astor has redefined the luxury standard with our consistent track record of delivering an impressive 21% plus annual returns to our investors, well above the industry average. So tonight, we do have the honor of hearing from our CEO and founder, Joe Burko. Joe is a nationally recognized inspirational entrepreneur with over 25 years of success built on profitable investments, ethics, and generosity. Joe's career in commercial real estate and finance dates back to 1995. That just speaks volumes about his expertise. In 2005, he founded Burko and Associates, which is the New York-based advisory firm, which is the sister firm to Astor Realty Capital, and his approach earned him the prestigious awards, including the coveted Power Broker designation by CoStar and the title of New York Signature Broker by Globe Street. Joe was also appointed as an advisor on the New York State Real Estate Board for a total of 9 years, appointed by 2 New York governors. So on that note, Joe, I will let you say hello. And before we do dive in a little further, I would also like to introduce the rest of our team who is proudly here today. Say hello, Joe, before I introduce the rest of the team.
Sure. Hi, everyone. Good to see you, and thank you for joining us. Laura, please, you can introduce the rest.
Yes, absolutely. So firstly, it is an honor to introduce our COO, Marika Dinzinhashvili. Marika directs and heads our global originations and our deal flow. So Marika, say hello, introduce yourself to the audience today.
Thank you, Laura. Hi, everyone. It's a pleasure to be with you, and I'm definitely looking forward to our monthly meetings and what's going to come out of it. Looking forward to hearing everybody speak. I'm the COO for Astor. I've been with Astor for over 7 years already, and my focus is to make sure and maintain all of our global relationships, operations of the firm, bringing international capital and managing all of those, keeping all the relationships very personal and bringing everybody close to us. Along together with Laura, make sure that all our investors are happy and working very close to everybody. And, really the most important thing for me is building those relationships and maintaining those relationships, whether it's with an investor or a global capital market, anything in between. It's all about relationships. It's all about trust, and it's all about transparency. And those are my main focus and my main areas to make sure every area of our company is on point with that. So thank you all, and looking forward to meeting anybody that's new. Welcome to the family.
Beautiful, Marika. Very, very well said. And we also have here our senior analyst, Alex Mokri. Hello, Alex.
Hello, everyone. I've been working as an analyst with the team for about 6 years now, mainly focused on all the new deals that come into our pipeline, evaluating if they make sense or not from not only returns perspective, but really location, sponsor, qualifications. And then I also work in asset management. So whatever we have currently invested in is, the quarterly asset management calls and seeing if the business plan is matching essentially with the current progress of the projects. So yeah, I'm excited to dive into these projects with you.
Wonderful. Thank you, Alex. And I do want to say, just before I pass it over to Joe, that immediately following this session, please stay tuned on the same Zoom link. You don't need to go anywhere else. We will be presenting our new investment opportunity, 14% returns, preferred investment in Dallas, Fort Worth. Dallas is one of the strongest markets in the United States and was actually ranked the nation's top market for real estate investment at the end of 2023. So that will be following this Zoom. Please stay tuned. And on that note, Joe, I pass it over to you.
Wonderful. Thank you very much, Laura. Thank you for the introduction. Thank you all for joining here. My colleagues, I can tell you, don't have a dull moment. Alex is chopping a lot of wood throughout the year. We see around 700 transactions, 700 or so requests. In certain years, that's more. At one point, we reached 800 requests for capital for us to participate. The reality is 98% of it we say no to, a variety of reasons. We try to club it together to what we call the triple C's, right? The collateral, the credit, and the character. We spend a lot of times on understanding the real estate, the collateral, right? Before we say yes to a project. Location makes a big difference. Understanding if this is an asset class we want to be involved with or not. Thank God, in our portfolio, we are close to 4 million square feet. We do not have exposure to office. We have a little bit of medical office, but no exposure to real office. Just a very, very small extent, and in the best markets for it, Miami. But we see a lot, we see a lot of requests for capital, and we dive very, very deep. So in the forefront of that is Marika, who's bringing a lot of that product, and the support that she gets, and not all of the support is here. Not of our, we're missing some of the individuals on this Zoom, but Alex is certainly doesn't have a dull moment. I can assure you that. Let's take a look at what it is that we've been doing. The concept behind what we're essentially coming to you with is that we're looking for transparency, hence the name Glassdoor. We want to make sure that you are investors, potential investors, or just friends and family that are looking into what it is that we're doing, have a good understanding of how the process goes, what it is that we're managing. We're making those claims, 4 million square feet, $2.5 billion. That's just a lot of product. We'll take a little bit of a look, and then we'll zoom in every month into 3 different properties. We'll also have a conversation about the market, where the market is, and why we think it's a good time to invest or maybe not a good time to invest. We'll have those conversations. We'll try to finish up at the top of the hour. If you have questions, while we speak, this should not be a speech. I'm very happy to make it a dialogue. So let's just dive right in. So every quarter, Astor sits down and asks ourselves the question, where is our portfolio according to this moment in time? Okay, it's called mark to market. All right, you'll hear this word across our presentation, mark to market. So what is mark to market? We basically either bring up the valuation, keep it as it is, as it's no change, or bring it down. Okay, why do we bring it up? We'll bring it up because rents might have gone up on a certain project, and therefore the net operating income would go up, and therefore the valuation would go up. We'll bring it down because we see that a certain market right now, sales of condominiums are not doing so great, and there's discounts. There's now like a 4% discount, a 7% discount. So we apply those discounts to our project at that specific moment in time. And if it's like a significant enough of a discount, then we'll mark the project down. So we always sort of like move along where the market is until the actual point of exit, where we effectuate whatever the returns are. So we are taking on some projections based on what's happening in the market. And to explain ourselves, when we have a project, we don't just look at our project, we also track other projects around to see where we are. Are we faring better? Are we faring worse? When it comes down to hotels specifically, it's been brought down to science, right? Because there's groups out there like Smith Travel Report, or Star Report, as it's known in the industry, and they literally collect data, right? They collect a lot of data on a daily basis. Hotels all across the nations, all across the world, are providing their data. And so obviously we don't have it in such science, but we track through information that's out there, through calling the local brokers community, talking to the other owners in the very similar markets, and always staying and keeping our fingers to the pulse, right? So today, we're in top 12 performing markets. Those are markets that have been showing very, very robust signs of population growth and employment growth. These are the areas that we feel comfortable. These are the areas that we invest. Okay, we stay away from tertiary markets, areas that are not showing the sort of like the dynamics that we're looking for. And the reason is because those areas, when things don't go so great, these are the first area to suffer. And the stronger area are the last one to suffer. And the kind of like the flexibility or the elasticity of those areas is very, very good. From inception, mark to market, I'm going back to that word, is about $2.57 billion in real estate assets participation. What does it really mean? If you look at our portfolio, we're going to take a snapshot of the portfolio in a few moments. Essentially, we do a mark to market of every project. So we might have a 50% ownership in a project, maybe let's call it a $100 million project cost to build. All right. So if we'll have a 50% ownership of this project, we look at the valuation, projected valuation of this project. Let's assume that we think it's worth 150 at its stabilization, right? So We look to see where the project is, where it would look to be a stabilization, and then we count that. And then we say, well, what's our proportionate share? And then we move that accordingly. From inception, we are with $111.7 million with capital under management. We also count our units. We're close to 3,000 units at this point, and square footage, gross, is around 3.9. I call it just shy of 4 million square feet in participation across the United States. So we're a national company right now, moving all the way west to Phoenix, Arizona, in fact, Scottsdale, Arizona, and all the way east to New Rochelle, New York, and with some concentration in New York and others in Columbus, Ohio, Tampa, Florida, Dallas, and other locations as well. We've had a project in Chicago that we've exited some time ago. This is effectively what our portfolio looks like. This is sort of like a more concise version. I hope you can see it. If you're watching this on your phone, good luck. I know it's not simple. But if you're on a computer screen, this is essentially from inception, all the projects that we've participated in, right? Projects that we put money. Now, we put money in 3 different ways into projects. It's either done through a loan. We'll give a loan to the project. We'll be a lender. Or some sort of a exotic sort of a situation, like a mezzanine of some sort. Or we'll give a preferred equity, and we have plenty of those. We like those positions. It reduces the risk a little bit. Sometimes we can negotiate current pay, and essentially places us in preferential treatment, in a priority, if you will, over the common equity. Okay, the presentation we're having later on at 6 p.m. for those who are staying is in fact a preferred equity. So it pays, I think, 8% on the current, and then another 7% or so on the exit. I'm sorry, 6% or so at the exit, for a total of 14%. But it has a priority of about $10 million of equity. But if you look at some of our projects, the one that's the top one, the one that says closing, is the one that some of you, or many of you, are now participating. And please work with Laura. This is the week that we're collecting capital for this project. This is a fantastic project. And so, you go down and basically we'll show you the location, what it is that we're doing here. It's a development of multifamily. Inception, we've came into the purchase of the land in May of 24. Closing, and then it's a joint venture, which means equity. The projected annual return to investor, that is net of our fees, is around 24% return, and projected cost is 98, and our expected valuation is $144 million. This is a project that will have 354 and about 290,000 square feet. You can go down the list. I'm going to spare you. What I do want to mention is below the line. Below the line is all the project that we've exited. All right, so today we have roughly, I would say, around $52 million in exits, money that we've returned back to our investors. Okay, I'll switch back. This will give us a little bit better snapshot of our assets under management, AUM, assets under management. So here's the breakdown. So we've had 33 transactions since inception. Astor has been around, now going on its 7th year. I've been around close to 30 years, but Astor's been around for about 7 years. So JV equities, these are deals that we come in as partners to a project. We simply come in, and we come in as equity partners. And we've invested $71.5 million to date at mark-to-market valuation of about 135, an average return of 26.9. On preferred position, 9 preferred positions have been done by Astor until today, with 36 million, mark-to-market around 52. And then average return on those is 18.3. This is Astor level average return. That's before we bring it down to the investors. On mezzanine, we're around 17.4 return. In senior position, which is pretty amazing, we're doing 15.8. If you blend in the entire average, our fund level average return is around 23.7% return. Not to the investors, because there's fees that we take out of it. We participate in some of the project profit, and so the investor get to see less, but on a fund level, we're looking at 23.7. In terms of what's active right now, we have about $79 million active, almost $50 million in joint venture equities. And on preferred, we have about $28 million. Senior position, we have just very, very little. And I expect this to change throughout the later part of next year. In terms of exits, we have, as I mentioned, total distribution till day to investors is 51.422 out of 32.8 million invested. So we created some pretty hefty profits to our investors over the years. In terms of location, where we concentrate and where we keep focus on, essentially, there's a lot of concentration in New York from inception, right? We started from New York way before the pandemic. We came out of New York City, so we feel very, very comfortable with the city of New York, its boroughs. We've done some tremendous projects, but it's kind of like slowly changing over the years as we're now moving, if you can see, from 63% concentration of capital in New York to 54, and then slowly it will continue changing as Florida is taking more precedence, moving from 15% to 18%, and I expect it to move even higher. Illinois, I don't see any projects coming back to Illinois anytime soon. We will be active in Texas. We will be active in Arizona. Ohio, we have a very unique project. And New Jersey, again, for the right project, potentially yes. So mark to market, I mean, from inception, we have about $192 million. Okay, so about $111 million under management and around $192 million in valuation mark to market. I know it's a lot of statistics. If anybody has any questions before we'll go to have a little bit of a discussion about current market condition, I think this is a good time.
Real estate, also the turnaround.
This will be a good time.
Just met my coach, literally.
What's the
So
average hold time? I don't know if we're doing questions now, but I just wondered, what is the average hold time for most of the assets?
Great question. And so it really depends on the asset class. When we're building, when we're coming into a building, and it depends on the size of the building, we'll usually determine how long the project will take. The longest projects tend to be large condo buildings. When I say large, I'm talking about, somewhere in the vicinity of 100 units or plus or more units. Those tend to be the longest projects. For those, we anticipate around 4 years to 4.5 years. If we're working on boutique condo projects, they tend to be smaller. They're going to be much smaller, obviously, much quicker to build, much quicker to sell. And so I would say that if you're looking at equity, 3 years is sort of like the average. Equity tends to pay better. Let me go back to. Okay. Equity seems to pay better. You can see it on joint ventures. Our average fund return is around 27%. Boiling down to the investors, they see around, on average, 22%, with some projects that are doing better than anticipated. We're going to review those in a little bit, and some projects that are doing as good, and some projects that are actually falling behind, not making losses, but not doing as well as anticipated. So that's our average. In terms of preferred, pretty much around the same time, I would say around 3 years. Preferred sometimes are better for investors that are looking for some current pay and are looking to reduce a little bit some of the risk associated with joint venture equity. Mezz, we try to keep it short, usually a year with a 1 or 2 6-month extension. And seniors are pretty much around the same time, around 18 months. The bottom two are always paying current coupons. The preferred positions, depends on some of the projects. They pay current coupons and then some catch up at the back end. But that's usually where it is. We try not to go beyond 4 years. Try very, very hard. In fact, we say no to project in our documentation. We keep the project concise to 4 years. Most of our investors, I find, are pretty happy with the short ones. You want to put your money out, you want to see it back, you want to see the return, you want to make other choices, you want to take a vacation, and you want to do whatever you want to do. Obviously, that sort of like cycle of capital is extremely important, both to us and to the vast majority of our investors. And so in order to do that, the balancing act is, if you go with very, very small project, what you'll find is starter developers, not enough experience, typically not enough capital, and that's not where we want to be. So to find a great project with a fantastic developer and to keep it short is not always easy, right? Therefore, going back to, to the team, we see a lot of product, and we're very, very picky about it. But the duration of time is important to us. I see Paul has a question.
Yes, hi, Joe. Thank you very much. I appreciate the
Sure.
invitation, and I'm sorry that my camera isn't on. I'm doing other things, and so, but I am very intrigued. I have a couple of questions. One, how do you decide which locations you want to get involved in? Is it basically the regular matrix where everyone is flocking to this area, like say Miami? I mean, it's a hot spot right now. Or do you see, say, if there's a component missing in a certain place, like say there's a need for multifamily in a certain area that probably isn't as noticed as say in Miami? Um, I'm just wondering, how do you decipher? How do you pick your locations, Joe?
I think we go bird's eye view and see what's happening at certain states. We follow the trends, right? I want to see population growth. I want to see uptick in population and uptick in employment. These are the two major ones. And usually those areas represent also an uptick in construction and building, and right, where we're not discovering anything new, right? Most are following the exact same trends. However, there's a herd mentality even in real estate and even in the construction industry and even in the development industry. And so this is what you want to watch out for, an oversupply. And that's the second thing that we track. So we look for, where's major employment, right? I can't, there's no better predictor than finding a location that is diversified in employment, what we call nothing but a one-horse town. We don't want to be like, in an area that has one mega industry. And if that industry gets hit with any externality, then everybody suffers, right? We want to see a nice diversified area of employment in various industries, and preferably not correlated one to the other. And that naturally creates, a flow of talent and a flow of individuals, and with it, a flow of capital. The other things that we pay attention to is, what's the political environment? There's a lot of discussions about blue states and red states. I want to stay away, I know we're in an election year. I want to stay away from, whether you're choosing to vote this way or that way. We are, however, not willing to take anything to do with political risk. I was on the board of the state of New York as a real estate advisor for 9 years. I've seen what political risk looks like firsthand. And there's a lot of pain going on in the real estate industry in New York City if you're not in the right sector of real estate. So why do we have such a concentration in New York? We have a short-term view of New York, and we kind of like come in, extract the best that we can, and come out. So it's a in and out very quick, 2, 3 years, 4 years, in and out. We're not long-term players in New York. We don't go into areas that have a lot of political risk, like rent stabilized buildings or rent control buildings or things with long-term tenancies and stuff like this. We don't touch that. So you got to know kind of like how to play with the political environment within the areas that you are. And we'll talk a little bit about this in a few moments, but I just want to kind of like give you a general idea. So you look at locations and you see the natural demand and you see the growth, right? And then you have to watch the supply. And a good example is going to be in the presentation, one of the 3 projects we'll focus on today. It's called a project called Caesar Republic. Okay, it's a very, very unique hotel that we have gotten into in Scottsdale, Arizona. So here's a little story about Scottsdale, Arizona. We're seeing big employment, big companies moving in, Tesla and others that are moving in and opening up campuses and calling for employment. And we've seen the drove of individuals moving away primarily from California through Texas into Arizona and all those different things. So you certainly see a beautiful, sort of like a beautiful trend, and a lot of salaries, very high salaries. But at the other side of this conversation, we're also seeing a tremendous wave of supply. And so we've determined, after looking at, at Phoenix, primarily at Phoenix, Arizona in general, but Phoenix particularly, for about a period of about a year and a half or 2 years, tracking everything that's moving over there, we've seen that the supply is going to create, it's going to create a lot of stress over there. It's a little bit too much, and it's too short, and it's too much. And so we decided not to touch the multifamily or the residential sector, the private homes and homes for rent, or BTRs, they call it in so many different names today. But we do know that we wanted to come in because we're seeing this tremendous shift in population. And so what we've done is we focused on a different sector. We look for the hospitality sector, primarily around Scottsdale, and we looked for the industrial sector. And so we saw that the industrial sector is also bringing a lot of millions and millions of square footage. And there's a risk associated with the industrial sector because everything you build in industrial is built on spec. Okay, so in other words, I'll build a 300,000 square feet box and I'll sit there and hope that somebody will rent it for me. And yes, the demand is there, and industrial is doing fantastic, but something about this discomfort about so many millions of square foot coming all at the same time said to us, say no to a bunch of deals that were thrown at us with very large companies with wonderful track records, and we still said no. We couldn't get the comfort. I couldn't get the comfort with industrial. So we said no to the multifamily sector, which is naturally the most, sort of like the most comforting place to be. We said no to the second most favorable sector, which is the industrial. And then we found this amazing project, which I'll talk about in a moment, which is a hotel, a unique hotel, a lifestyle hotel, which we knew is exactly what's missing. You got so many people, you got so much employment, you got so many salaries coming in. Where do they all go to eat? Where do they all go to play? Where do they have fun? Where do they have their conferences? Where do they do all those different things? And so we'll talk about this. And I hope that answers your question.
Yes, thank you, Joe.
You're very welcome. Yeah, so let me just continue here. Let's talk a little bit about the state of the market. Those of you that have been in various conversations, the market has three main cycles. Every market sort of like experienced three main cycles, and each one lasts anywhere between 3 to 5 years, 3 to 4 years. That represents the 9 to 12 years, sort of like entire market cycle. Usually the market is sort of like comes where we are in the market right now is sort of like the bottom, right? Prices are coming down, and we see it across the board, all asset classes, right? Directly correlated with the cost of interest rates, simply directly correlated the cost of interest rate. Capital determines how things are going to go. I sometimes like to quote the great economist Milton Friedman: the only thing that matters is the money supply. And so with that in mind, when interest rate is, 2.25, and you can buy a house and you can borrow $2 million, and it's going to cost you so little in comparison, you're going to borrow as much as you can, and you're be willing to compete with your neighbors and pay a little bit more for the house. And so we're creating this kind of like this, what we call eventually a bubble, right? The cost of capital is very, very low. Capital is so available, so readily available. And so we go into this growth period that ultimately absorbs itself and becomes a bubble. Okay, that's the most riskiest part to buy real estate. It's the absolutely the riskiest part. It's a great time to sell. If you got good real estate, it's a wonderful time to say goodbye to it and to make your profits. Following that, there's usually kind of like a cooling period, and then at one point there's a drop. As far as we're concerned, the drop has happened when the Feds start increasing interest rate. And for our sake, we're talking about March of 2022. Sometime around May, we've stopped operation. We said this is becoming too quick. Here's a first quarter percent increase, followed, if I'm not mistaken, by a 50% basis point increase within a short time span of a couple of months. And now they were talking about a third increase, and we're in May, and we said, okay, put the handbrakes on, we're stopping the operations. Ultimately, values will start coming down. Now, not everybody was paying attention. People were still buying and still doing, and the euphoric part of what happened just before it, when interest rate was low and everyone was a real estate expert, everyone was still buying, we stopped. And we stopped for about a year. We stopped for about a year. We had one commitment that we've done way ahead of time. That was in December of that year. And it was a construction of 100 units in New York. We had a commitment. We fulfilled that commitment for December. Money was earmarked for it, and that was it. And so essentially, we waited for the market to start dropping. It takes a while. There's always a lag time, and eventually the market starts dropping. We've had 9 consecutive increases with it in order to combat inflation. Inflation, if you remember, in November of 22, we were 9.6%, and the fear was double digit inflation. And so our focus was mainly asset management, making sure that our portfolio is doing well. You know, it's one thing when you sign a loan at 3%. Now the loan is at 8%. Think about a $50 million loan at 3%. Now double the interest, or double it a time and a half the interest. It's very different. And so, you know, that was our focus. Sometimes in the summer of 23, we felt that we sort of like reach a stabilization point. It's been a number of months at that point that the Feds have sort of like stopped the increases. The inflation was starting to come down. The fundamentals were starting to come back down to earth. And now we were looking at sort of like a period of a bottom. From the summer of 2023. You know, 2023 was a rough year. We've done a couple of transactions, mainly as preferred positions, right? Mainly as preferred position. A little bit of a money that was needed in one project, a little bit of a money needed in a different project. That sort of a thing. Putting our positions in a very safe space. And then ultimately, you know, 2023 led into Q1 of 2024, where the newspapers are finally starting to say we're bottomed out. The reality is we've bottomed out sometime in the late summer of 2023. We haven't seen a lot of transactions, but there was a good amount of pain. We're quoting this because Blackstone, which is a company that we obviously respect very much, you know, is now finally saying, and this is Q2 of 2024, it's finally saying Blackstone is deploying capital because it views the current environment as ideal. There's a bottoming happening, and they further on go to say, this is when we do our best work. So that's essentially what we're looking for. I've seen this is probably my 6th cycle. Okay, I started from a very rough cycle in 1995. We were sort of like slowly coming out of a very long RTC years, very rough cycle. And I've seen sort of like how things are moving slower. Things are much happening much quicker now. And so, you know, when you go through that cycle, it's painful, it's fearful. The newspapers, people don't feel good about it. There's a lot of uncertainty, but you really got to move away the noise and really focus on what are the fundamentals. What are the fundamentals? We're looking at a 3.5% environment. Now it's 3.3 this month. The Fed said it was 3.4 last month. Okay, we're sort of like, you know, the last mile stretch is very hard. They're trying to get into 2% environment. It's not simple. That last 1.5% is very stubborn. But the fundamentals are this is no longer a 9.6% environment, right? Not a 9.6% inflationary environment. Every time I drive with my wife next to the gas station, it's like, you see, 10% less on the gas. Those things make a difference eventually. I believe that we're heading into the right direction. We no longer have the kind of issues we've had a year and a half ago, or even 2 years ago. So the environment is very different. There's a lot of pain out there. We're also in a year that the feds are constantly saying, well, listen, we're going to start dropping rates. And so we're sort of like, at the bottom, but there's also a good amount of light at the end of that tunnel. I don't want to wait until the light becomes a projector as anybody face, because now they will be moving away to the middle part. Okay, so there's three different parts. So there's the euphoric part where you want to be a seller. There's right, and that's about 3 to 5 years, 3 to 4 years. There's the bottoming part, okay, the down part where you want to be a buyer. You don't want to jump right away, but you want to be a buyer. You want to wait for the market to drop to correct itself. I believe the correction has happened. There's now enough articles out there, enough information slowly starting to come up from Fannie Mae and from others, that there's more activity, that they're sort of like balancing things out. And then there's kind of like the growth part, right? After this part will be the growth part. The growth part is when banks are coming back, institutional capital is coming back. There's a lot of money sitting on the sidelines, right? Think about the managers of a large institutional capital. They're not running anywhere, right? There's no need for any sort of entrepreneurial risk. They're not going anywhere. They're sitting very pretty on capital, and they're pretty okay. And so we're tracking all those things I wanted to point out. In New York, why do we have so much activity in New York? We have so much activity in New York because New York is in a crisis. They have many crises, but the crisis that we're referring to is a 1.4% rental unit vacancy. The lowest it's been in 56, now it's already 57 years. The lowest it's been in 57 years. I have not seen, right? I've not seen the type of numbers like we're seeing in New York, right? Those of you who are participating with us in projects, we're seeing $110, $120, in some cases even more per square foot. This is an unbelievable, really an unbelievable amount to pay rent on tiny closets. We're talking about 550 square feet, and we're reaching tremendous numbers, $6,000, $6,700, close to $7,000 for small shoebox sized units. And people are fighting to get in, right? It's an unnatural situation. Guess who created this situation? If you're thinking the politicians, you're probably right. Why do we focus a lot in Florida? Obvious reasons. It's despite rising interest rate, Miami's investment climate remains positive. Well, it remains a lot more than positive. While the condo sector and the multifamily is going slower, it's about 50% drops in activity. What hasn't dropped is actually price point. Price point is holding very, very strong. Now, those who don't buy need to rent, and Miami, particularly in South Florida entirely, is doing extremely well. In fact, it's not the case throughout the state of Florida. We're staying away from many different markets in Florida, but we're highly focused on this market. So while we've seen other locations such as Gainesville, such as Tampa, such as Orlando, very mediocre, lukewarm rent growth of maybe less than 1% growth year over year in rent, Florida is still doing close to 5%, 4.9% to be exact. There's exactly the locations we want to be, and this is exactly the kind of projects that we want to be taking part of, because we're seeing the demand, we're seeing the crisis, we're seeing how difficult it is to rent an apartment here. So we want to be sort of like, in the immediate ring outside of it, half an hour away, 40 minutes away, which is where we're putting a lot of our focus. It also has a social component to it. We're offering great product around Florida, fantastic product at a very affordable price. I want to point out to one other thing, and that's if things will not change, and I'll just hover through it. The National Bureau of Economic Research at the end of 2023 issued a very interesting report. It's a 57-page report, and it's sort of like your eyes glaze at some points, but it's extremely important. The message is there's going to be somewhere in the vicinity of around 300 banks that will probably fail, that will go insolvent in the coming 2 years, if interest rate will not start coming back down. There's around 300 banks. There's a tremendous concentration in banks around the sector of the office. The office sector is doing poorly, very poorly, and there's no end in sight. And a lot of banks are holding on average 25% of their portfolio in commercial real estate, And out of that 25%, we're talking about 44% concentration in the office sector, which means that there's going to be a lot of losses. And those are going to be banks you never even heard of, small banks in the Midwest, banks, that they're just barely $25 billion and less. But there's going to be a lot of consolidation and a lot of that stuff. The one thing that stood out to me as a last point in regarding this is the very same report, which was commissioned, essentially, was commissioned by the Feds, and was hired by some professor from a number of different colleges, also determined that if all things were equal, but the interest rate will not jump like it did in such an aggressive turn in such a short period of time, none of those banks will face the insolvency. Interesting comment. Let's take a look at three of the assets that we want to focus on today. Scottsdale, Arizona is one of them. It's a fantastic project that we've started, as I said, after carefully looking at Phoenix, carefully evaluating what's happening, seeing the demand, but not overlooking the supply. One second, I see Paul has a question. Paul, please.
Yes, Joe, I'm taking you up on having this interaction. So speaking of banks, excuse me, and a lot of these banks hold more than 40% of the office buildings. Excuse me. Do you think that San Francisco falls into that net? And that's one question. The other one, are you interested in places like San Francisco or even New Mexico, where Intel has invested $3.5 billion in a city in Rio Rancho? That's where I opened up an office. But I'm just wondering, do you collaborate as well in these two states?
I mentioned earlier, thank you for your question, Paul. I mentioned earlier that what we don't know how to evaluate is political risk. I really don't. I don't know what the powers be in those particular areas are going to come up with next. I really don't know. And I think that San Francisco, for me, and again, I'm not an expert in San Francisco. Please, I'm talking with limited knowledge. I will share with you. I've read about San Francisco. I've read about Proposition 47. I've read about how they're truly killing the city. It's an amazingly beautiful city. First time I visited San Francisco, I was 8 years old. Amazingly beautiful city. They had everything going for it, and they just and who do just a bunch of politicians out there, a bunch of individuals that have simply crushed it. And so we're seeing while I am tracking that there's kind of like, industry starting to come back in, and specifically around AI, and there's maybe breathing a little bit of new life. Think about the quality of life there. Think about who wants to go to an office in downtown San Francisco. Who wants to go next to everything that's happening on the street? I mean, even if you do, it's not safe. And it's a fact. I don't want to give opinion, but it's a fact. It's a very unsafe place. So I think, every area has a market cycle. I don't want to take part of it. I do, or I might say differently, I am aware of a LA company that is now bidding on a San Francisco, and I think they won on a San Francisco building. I mean, we've seen values drop by 80% over there. And so, I remember this fellow is telling us a story about how we came in and gave a bid, and he started bidding lower and lower and lower, and eventually they came down to his number, and he ended up buying it. And I wish him well. But it's not an area that I know well, and I don't feel comfortable with it. There's also other issues, even if you're outside of San Francisco. California itself represents all sorts of tax issues that we just don't know how to handle. Okay, we're just and there's no reason for it. Now, there are those that are super contrarians. My very good friend Ethan Penner is very much a contrarian. Those are the guys that are making very different bets. It's just not our style. Completely not our style. So every now and then we see something in San Francisco, we see something in downtown LA. But we just don't have enough knowledge to pull on something like that. And I wouldn't go as far as to say that it's a binary bet. And when I say binary bet, I mean, you can either win and make great, or you can lose everything and lose the building. I just don't do those bets. And we're just not designed this way. We're conservative, preservation of capital, and all the stuff that's leading us a little bit different than how things are going. So yeah, we don't do that. Kat, do you have a question?
I am super excited to hear about the opportunities that are coming up. You had Scottsdale on the screen, hoping we can get to that in short order.
Yeah. Mhm.
Okay, great.
Okay, so this is a deal that is done already. We're sort of like doing a recap every month. We're going to have a little bit of a recap of some of the projects that we're doing. That's sort of like showing our investors and friends here how things are moving. So it's not available for investment, if that's what you're asking. It was
Oh,
available for
that's what I was
investment 3 years.
asking. That's what I was asking. Okay, all right. So this one is closed already. Okay.
Yeah, no, it's been closed for about 2 years, but it gives you a very good idea of where things are. What's unique about this project is, it's the first non-gaming Caesars. So it's the Caesar brand that but it's the first time that Caesars has gone out to do a hotel without a casino. And so we've teamed up with a local operator with 40 plus years of experience, fantastic group. We're super happy with them. And I got to tell you, they've turned this building around. They've created a 265 key, gorgeous property within 2 years, a little bit over 2 years. And we are now, is eventually, effectively, we've opened the property in March 6th to be exact, of this year. And the things are moving really well. What's really unique in terms of what's happening over there is that the food and beverage, that kind of like you can see kind of like the Arizona, the bottom picture shows you Camelback, which is a beautiful scenic area. We're next to one of the most successful malls in the United States called Fashion Square Mall, 2 million square feet. Kat, you'll have a great time. I know you're very stylish. So all the stuff that you want is right next door. But this hotel is exactly what the market is needed, because with so much multifamily coming in, with so much homes coming in, so much population, they were missing life, right? They were missing the playfulness of things. They were missing. So we were very happy to go into a lifestyle hotel. We'll take a look a little bit about the numbers.
Joe,
And
before we jump into the numbers real quick, I wanted to just make sure to reiterate for some new investors as well, and for Kat too. So, for example, the Caesars Hotel, whenever we do business with any new partnerships and deals that we get into, when we have those specific developing partners that we deem to be our star and top developers, we maintain those programmatic relationships, and we make sure that we look at all the deals that are coming up. So, for example, in this hotel investment, there will be more coming up that we are looking at. It's still very early in the stage. So just know that whenever there are deals that we get into, once we establish a really strong partnership and a good developer, we'll typically do those next deals as well. So we'll typically do multiple deals with the same partner to ensure efficiency and that great quality that we really love so much.
yeah,
Thank you for that.
good
Yeah,
comment,
and you have a
good
track
comment.
record of how they work as well. So I'm sure that
Exactly.
gives you
Exactly,
greater level of
exactly,
confidence. So
exactly.
absolutely.
Yes.
Yeah, and everything is much easier. The first negotiation, we ask for everything under the sun, the control rights, the major decisions, all those different things. And it's not an easy place to be, that negotiations and stuff like that. But once you go over it, they get to know us. I think we're fantastic partners. Whenever there's an issue, we jump right in. Whenever there's something that's needed, we jump right in. And when we get to that familiarity, is what we look for.
Yeah,
Um,
and let us know if you plan to visit the hotel. We'll make sure to drop a word.
by all means, by all means.
Planning
Well,
my
if you don't
next
mind,
trip already.
Okay, perfect. I'll reach out to you.
I'm just gonna slide through it because at 6 p.m. we have a presentation. I want to have a chance to finish here. So please, let's maybe hold the question till the last moment. So that's our
Also, you
hotel.
can stay on till you can stay on for later and address those questions for the continued Zoom as well.
And so we're showing here kind of like the original versus the current, right? So the original underwriting, where we were, where we are today, it's, much better. Without taking you through all the numbers here, we got a recent appraisal from CBRE that shows the hotel at a valuation of $206 million. While we're still underwriting it conservatively, you can see where's our original pro forma was, which is $165 million gross exit value. Okay, blended cap rate, gross exit value. So initially we were thinking 165. We usually tend to go conservative on valuations, and then if the market gets better and if the product is really, really great, then the valuations will go up. So we evaluated 165. We're now evaluating on our mark to market the value at 183, but the appraisal what was done in March came back with its own valuation of 206. If this was the case, I think we're doing really well. Our projected investor return is just scraping around 30%. We might even beat that number. So we'll wait and see. But so far things are looking extremely well. Another project that I wanted to touch on is New Rochelle, New York. It's 168,000 square feet, rental building, 144 units. It's a New Rochelle, for those who don't know, is sort of like a 30-minute quick train ride from Grand Central in New York City. You hop on a train, you're sort of like in the center of New York City, in the business hub. You hop on a train, 30 minutes later, you're sort of like in a very nice green area with great schools and great community and stuff like that. During the pandemic, there has been a big push. A lot of people wanted to leave New York. Many neighborhoods became very uncomfortable. And so we wanted to follow that trend as well. So it's a nice and close proximity, very easy, 30-minute train ride. This is a project that we've done and which is a preferred equity, right? Preferred equity. So we've reduced the risk significantly. Where we are in the project right now is that the project is fully built. We have 144 apartments. We're around 75.5% occupied. We have 109 out of 144 units, and it's moving fairly well. Project looks fantastic. This is the interior shots. This is the existing. This is not rendering. This is the interior shots of some of the units inside, of the lobby, the entrance. Really looks fantastic. There's a lot of areas, a lot of playful area. The upper left, you have sort of like the top floor. We have a beautiful residence lounge, and you can see it. It's kind of like facing, the Long Island Sound. Really wonderful, wonderful place. And there's lounges and there's rooftops and basketball courts. Just a great location. With barely a minute left, I'll touch the last project that we're doing. Cold storage facility in Columbus, Ohio. Okay, we're expecting stabilization value to be around $23 million. We essentially took an old warehouse. The story of cold storage is quite an amazing story. I want you to think about, the change of how this, in the last 5, 7, 10 years, and certainly since the pandemic, how things have really shifted. You're buying everything online, and certainly you're buying your refurbished goods online. And so the need for cold storage is paramount. Giant Eagle is our tenant right now. It's on a short-term lease with an option to take an additional 10 years. They're already paying us $18 a square foot. We projected $13 a square foot, or we actually projected a pro forma $12.30 a square foot. And so with this in mind, obviously the project is going to show us better valuation. But so far, we don't want to be selling the project. The year is still sort of like a funky year. We were hoping to sell the project and exit sometime in September 2024, but the market is still finicky, and we think that it's better to extend it another few more months into 2025, when things will get a little bit more stabilized right now. The only people that are selling right now is those that are absolutely have to sell and have no other choice. This is certainly not the case here with us. Again, mark-to-market valuation are essentially our total sources are $17.5 million, our purchase price, and everything else is broken down here. We're anticipating a pretty nice return of around 37.55%. If we were to keep it for 30 months, it's in fact going to be going towards 36 months. And our projected level equity is about 106% versus 94%. So 106% return, project level returns versus 94. We're going a little bit longer, but the returns are certainly making it well worth our time. Some of the interior projects, some of the interior shots of the project. Yeah, nothing too fancy, but certainly a moneymaker. So we're done at the first part of our presentation, and I want to thank you all. For those who are interested to stick around and to listen to our preferred equity pitch, it will be coming up in a minute or so. And thank you all for joining. Once a month, we'll go through very same reiteration. We'll talk about where we are, talk about our portfolio, focus on 3 other assets, and then talk about market condition. Paul, I'm with you. You have a question for me?
Yes, real quick, Joe. I noticed on your Gantt charts that Astor comes in between the acquisition and construction stages. Is that true, or do you not get involved in acquisitions? How can I understand?
So yeah, we have gotten involved in acquisition. We obviously prefer projects where our operating partners come into us. Like, very great example is a project that we're doing now. Our partners came to us with a project that they've got into contract over 2 years ago. They've done their studies, they've done their homework, they got the permits, they got all the stuff going forward for them, saving us a good amount of years. Somebody asked earlier, how long do you like to stay in project? The shorter, the better. And so at that point, the project was almost kind of like, wrapped with a bow. And that's when we placed our capital and got in to close it. And then afterwards, we went to our investors and raised the capital necessary for the deal. Now, that's not a poster child. If there's different opportunities, we'll come in, we'll buy the project together. That's perfectly fine. The last project that I showed, Columbus, Ohio, was an acquisition. We all bought it together. We went through the planning phase, but that's, every project is very different. Our preference is to keep it short. Why? Because that's what our investors are looking for. Another reason why we're able to show returns in the 20s, mid-20s, it's because we don't extend project to 5-7 years, right? We keep it short. Our investors want to put their money in, they want to get their money back, and they want to make their decisions, after they do it. Different part of the conversation, which is not part of your question, is, what about taxes? How do you deal all the time with the tax situation? So, we have mitigation ways to mitigate taxes, IRAs and other options as well. I think what we'll do in future Glassdoors, we'll bring some of the professionals that we work with to maybe talk about some tax mitigating ideas and structures, and kind of like offer a little bit of a value that way as well.
Thank you, Joe. Appreciate it.
You're welcome, Paul. Thank you for the questions.
Okay, so on that note, we are welcome to anybody new who recently joined. We are very excited to dive in and present our new investment opportunity in Dallas, Texas, a suburb of Dallas, Texas. This very exciting opportunity is offering 14% annual returns. It is a preferred equity investment in the Arlington neighborhood of Dallas, Texas. This opportunity, most excitingly, is available to accredited and non-accredited investors. Sometimes in the investment industry, we always hear accredited investor and accredited investor, and sometimes our non-accredited investors can feel a little bit left out, but rest assured, Astor ensures that we are inclusive of all investors, regardless of your status. So this one is for you. So I'm going to share my screen, and Joe will take over and dive in and go through the deal. I will be presenting I'll drop the deal room into the comments so that you can post Zoom, have a look at the full due diligence, the full OM. And of course, we are available here. Please, everybody has my email address, and I'll also drop it into the chat in case you don't. We are available to have a one-on-one conversation to discuss your participation in this investment. So give me 1 second and I will bring up my next presentation, and Joe will welcome you back. And as always, guys, please again, take the opportunity, collaborative session, to ask questions relating to this particular investment opportunity as we go as well.
Okay, very great. So I see that the vast majority of our participants are staying for the second part of the conversation. So I'll do it quick. Essentially, this is a project that we've acquired in Dallas, Texas. It's a project that is composed of 205 Class C apartments, blue color. When we bought this deal, our average rent was below $1 a square foot. In fact, it was 98 cents a square foot. The buildings needed repairs. The building needed renovations inside the apartments and some of the outside areas. The swimming pool has been green and quite unpleasant to look at for now a number of years. The place didn't look like it does today. It wasn't as friendly and as peaceful as it is today. And so we've embarked on a project with a local partner, a local Dallas partner, to acquire the asset and to come in and to do the renovations and so on. Since we have taken over the project, we've removed our operating partners, and we're now operating and managing the project with a local management company that is working for us while we do our asset management. And we're the one who's visiting, we're the one who's helping out with the leases, and there's a lot of work that needs to be done here. When we took the project, it was around 65% occupied, with actual people paying rent was somewhere in the mid 40s, upper 40s, maybe 50%. We are now moved significantly higher. We're now just shy of 80%. We removed a lot of the bad elements. We've fixed all, a lot of the stuff that was going on, from water leaks to roof situations to all sorts of mechanicals, without going into so many things. In order to do that, we had to raise additional amounts of capital, and we've been doing it over small increments, okay? Taking care of one issue at a time, raising it in small increments. What we don't do with our investors, we don't force our investors to do the capital call, right? So for those who don't know what it is, a capital call is when you go into an investment, you raise a certain amount of dollars, but then something happens that is outside of the control. Maybe you overlooked something, maybe a tree fell, maybe the insurance didn't pay. You need additional capital. Things happen in the world, you need additional capital. Certainly, when interest rate moves so aggressively, okay, and valuation drops so abruptly, you'll need more money to work things out. On top of it, we've had a bad partner, so Astor stepped in, removed the partner, and we are now the managers for the last year plus. I think the project looks fantastic now, and that was obviously the work and the attention that my entire team, myself and Marika and Alex and Laura, and then Andrew, who's not here right now, and others have been putting into it. And so what we've done is we raised small amounts of capital in order to continue the project forward. Essentially where we are, we've opened up the pool. We closed the back door. We raised enough money for renovations. We've done a lot of work, not only to improve the property, but also to reduce the expenses, which we were able to do quite significantly. If you look at the overall project right now, we're around $35 million. We're now going to be taking around $1 million over the course of the next, call it 9 months or so, in order to continue doing small patches of area where we'll need more to take care of some of the final things until we'll reach somewhere in the vicinity of where we want to be, which is around 90+% occupancy. One of the things that we've done recently is replace the management company. We are now starting with a new management company that owns about 14,000 units in Dallas and the immediate area. And most importantly, they have 3 properties, somewhat similar to ours, not as nice, not as large, but somewhat similar to ours, about 700 units up the block from where we are. I'll go back to this slide for a moment. We track our neighbors, right? We track our neighbors to see how well they're doing, how they're getting on rents, how they're renting their 1 bedrooms or 2 bedrooms, what sort of occupancy they're having. The 3 properties that we are looking into, 2 of them are here, in fact. One of them is operating at 98% occupancy. The other one is operating at 98.7% occupancy. And so they're owned by 3 different individuals, but we went and we sat down with a management company that's been managing those properties for about 15 years. And we've had a conversation. We realized that the management company that we have, the local management company, has not been able to sort of like create the stability that we're looking for. They've been very, very slow on leasing. While we were doing really good on renovations and improving the apartments, the leasing part has been lacking for the last, I don't know how many months. They've been changing individuals and just was a bit of a mess. So we said enough is enough. This is the last stretch for us. And so we're going to be raising in small increments, $25,000 additional capital needed in order to continue with this project to reach full stabilization. The projection is as follows. We anticipate to exit this project, if not in April of 25, then we might be going 1 more year out into 2026. Why we're doing it? Valuation on multifamily has gone down so long that interest rate for those properties is still hovering at a very high level. Today, if you'll borrow money, it's going to cost you around 6.5%. The agency loans of Fannie Mae's and the various agency loans are still somewhat expensive. And so the trades that are happening now are trades that are just not accretive. We have about $10 million of our capital in this project. And it is really not a good time for us to sell. And so we're holding to this property. We've improved it. We'll improve the occupancy. We increased the rent significantly. As I mentioned, we've taken over the property was 98 cents. We're now, I think we're hovering around $1.45, and we expect to stabilize at around $1.55 or even a little bit higher than that. It's a significant improvement on one side, a significant improvement on the valuation, but the market is not where we want it to be. As mentioned earlier, Dallas is the strongest, one of the strongest markets, very, very comparative, very comparable to the market in Miami. But things are not as good as they were. So, in essence, this is what we're doing. So Devonshire is the new management company. As I said, they're doing really well. They've been around for many, many years. Right around us, they own several thousand units, and up the block from us, 700 units. Together will be 900 units all combined. We'll create a lot of economy of scale together. This is all the properties that they're managing. Wonderful individuals. We're already started the last several weeks to do what we call like a dual management. So we have some of the individuals from Devonshire, some of the individuals from the previous management company, and I think we'll do well together. let me go into the numbers a little bit and what are we essentially asking for. So we're looking for capital that will pay our investors 8% on a current and another 6% at an exit for a total of 14%. It's called preferred equity. Let's go into the numbers for a moment. So these are the numbers. We essentially have a call it $21 million first position mortgage with a group called Lument Bank. The preferred equity will be, including the final raise, will be around $4.6 million. As I said, we raised around 3.9 at this point. We've reached to a certain point where we've done all of the heavy lifting. The property looks fantastic now. The pool is open. There's an actual community that we were able to create, getting rid of all the bad elements. Common equity in the project, we have around $9.8 million, and total sources around 35.3. And so you can see the current basis, what we're going to be doing with the money. We have some age payables, just the last part of age payables that we have to pay. Some of the units that we still need to renovate from 205 units. I think we've reached at this point somewhere in the vicinity of about 160 plus unit altogether. We need a little bit of reserves, contingencies. We always want to have a little bit of additional money. And we're looking at around just shy of $1 million. We're going to be raising in small increments. We're not looking for a check of $1 million tomorrow morning. Those investors that are looking to have an income stream and are looking for short term, maybe a year, maybe less than a year, this might be a good opportunity. Open to any questions you might have. Yes, Paul, I'm with you.
Hey, Joe, I was wondering, with the construction renovation, do you guys,
I'm sorry, I cannot hear you. A little bit muffled.
oh, can you hear me, Joe?
I don't know if it's just me, but I cannot hear you.
I can hear you, Paul. Fine, Paul. Joe, can you hear me okay?
I can hear you, Laura.
Can you hear me now, Joe?
A little bit better, yeah.
Oh, okay. I'm wondering, do you have any problems with your labor pool? Do you basically look into those markets, or do you go ahead and have your preferred tradesmen come with you?
So no, I mean, we're in this particular market. This is a market that we've teamed up with another group, and pretty much year one, the very seasoned group, I have to say, very local seasoned group in Texas, that have done, over 17 plus years of running and buying and selling very, very similar properties. And within the first year, we're starting seeing that there's just no substance over there. There wasn't any good substance. We couldn't get performance metrics. We couldn't get the rents collection as we were asking for certain documentation. Our asset management team were asking for simple stuff. We just couldn't get that stuff. And so after several months, maybe 4 months or so, we started realizing that we have an issue. And so we've hired a local asset manager to visit the property on a weekly basis, to physically show footing on the ground on a weekly basis. And we'll be starting to hear that there's just, the lights are on, but the landlord is not there. And so through negotiations, we sort of, the way that we negotiate our documents, with local partners, we always reserve the right to remove them if we're not happy with the performance and to step in ourselves. And in this particular case, that's exactly what we've done. We removed the management company, we removed our operating partner, and we stepped in and we raised the necessary capital to do the projects and to do it well. We reached, after a year of doing that, we reached a certain plateau with the current management company. But everything is done in-house. Everything is us. You know, Laura is sitting here. She's the one and running pretty much marketing for the last year or so. Alex has been analyzing with the current management company how the competitors are doing and how we should be pricing the various units. So it's a collaboration, which it's holding the locals' hands, you know, but really going very, very deep into the asset management. So we have weekly calls. At a certain point, we started having daily calls with this management company. And then at one point, we've reached a conclusion that while they were really instrumental in getting all the bad element out, in really improving with all the subcontractors, improving the property and everything else, they really are lacking in the ability to lease up. It's not a bad location. All our other partners, sorry, not partners, all our other neighbors are doing much better. And so we've determined that we've gone with the current management company as far as we could. We looked around, we looked for the best. I believe we found the best. Devonshire, as I mentioned, manages 3 complexes up the block from us, literally across the street, up the block, 3 complexes with 700 units, hovering occupancy at 98.7%, and the third complex is around 97%. So 3 complexes. I assure you one thing, none of them look as good as this. This is a unique property. We're a corner, they're not a corner. We're a big corner property. We got a lot of grass area, a big pool, very, very open. We have a couple of laundromats. We have a reasonably nice clubhouse. I wouldn't call it too nice, can do better, but you know, reasonably nice. Plenty of parking, plenty of space. And so there is no reason why we're probably the best in the immediate area. There's no reason why we're struggling to move away from 75%. Well, the only reason is because we have bad staff. And we recognize we have bad staff because my staff shouldn't be the one hand-holding, right, and teaching those individuals how to work. If you hire people, hire professionals. And so we've decided to pivot. And so going forward, at the very last stretch of this is going to be with a local management company that we're very, very, very impressed with. Very impressed with. They certainly are taking a much stronger lead than anybody else. Our competitors across the street in other complexes, except for the 3 that I've mentioned, are around 90 and 91% occupancy, which is really not bad numbers. But I'm looking at those guys, and they're running a very, very tight ship. So
let me ask
I
you, Joe.
if I may add
Oh.
very quickly to the management companies that their referral program from the other 3 properties will apply to the junction as well. So there's a lot of economies of scale that we can benefit from by having Devonshire as our management company.
Yeah.
So Joe, would you say that you guys are successful because you concentrate on, say, the management and administration of your assets versus getting in and doing it all? I'm just wondering if you're not from this area, how are you guys successful to get things done? Is it that you look for the best? You guys must be doing a great job looking for people, because if there's other people there that have bypassed, say, this project, is it because you know where to get the money? You're a person that has this open for investors, where probably someone that's close by doesn't have that niche, and so I'm just trying to get more of an understanding with your business.
I'm not 100% sure I understood the question. In what sense we are successful or not? I mean, it's a moment in time. This is a project that we're got going on 2 years. I think we want to exit, if possible, if the market prevails, then sometime next year. Certainly, we want to refinance and repatriate a lot of the preferred equity. You know, we track everything. I don't know if that's something that's natural for everyone. I suspect it's not. I don't want to know only what's happening in my property. I want to know what's happening with the neighbors. I want to know what's their occupancy. I want to know what things are trading for in those markets. I'll give you a good story as an anecdote. In late 2020, we had a beautiful project similar to this in nature, actually, very similar to this. A little bit smaller, 136 apartment in Tampa, South Tampa. Went through the pandemic, very uncomfortable situation. Pandemic, people don't pay rents, but here we are, the late part of 2020, and starting to feel that the market is really shifting. I got a phone call from somebody who heard that we bought this complex and asked if we wanted to sell it. And after kind of like a light negotiations, I got the same number that we were projecting to exit. It was around $18 million, just shy of $18 million. That would have been our strike price if we were to hold this project for 3 years. And it took me a moment to realize that, something has been going on, right? So you always have to have your fingers on the pulse of the market where you are and try to understand what's going on. I made a couple of phone calls to some of the local brokers, some of the better brokers out there, back and forth conversations, and they're telling me, look, there's a lot of activity. There's a lot of activity coming in mainly from the Northeast. People are coming with large checks and they're looking to buy. And I was like, it makes sense, right? People have been sitting there for a year. They think that they're going to find all the carcasses coming out of the pandemic. They know they have a short window and there's just a lot of it. So all of a sudden, kind of like, that's happening. On top of all of this, interest rate was like people were getting loans at 2%. 2%, unheard of. And so we did like a little bit of a beauty contest, as we call it in the business. We brought 5 major brokerage companies, CBRE, JLL, big national companies with local footing, some of the best guys over there. We chose one group and we went out to the market. Within 3 months, we've had, I think, over 23 offers, and we circled around 3 potential buyers and ended up selling it for 23.4%, 23.4 million. It was at that point, it was almost like a 2-year mark. The return was 50% annual. So the question is, and I've been asked before, this is the most amazing thing. My investors were making 43% on their money, 50% annual, after we take a little bit of a cut. 43% a year, 86% or something around those lines after 2 years. I mean, who heard of stuff like that? And I was getting a lot of praise, but I told everybody, I don't think you get it. It's not us. It's the market. I didn't cause that. I really didn't cause that. I was doing what I was supposed to be doing as the manager of your capital. I was keeping my fingers on the pulse, constantly keeping my fingers on the pulse. So that's what I'm doing here. I'm keeping my fingers on the pulse. I'm friends with the neighbors, the property owners next door. I know their staff. I know the same issues they have. When they're struggling with insurance, I'm struggling with insurance. We come up with information. We come up with solutions together. And when I see that my management company has reached capacity, and I know that my neighbors is doing 90% and the other one is doing 91%, and others are doing 94, 95, but I see that somebody's outperforming everyone else at 98% and 97% and 98.7%. I want to work with that guy. Does it make me better? It's what I do. It's what I do for 30 years. So I appreciate the compliment, Paul, but it's really keeping your fingers on the pulse, being involved. Why did we remove a Texan with 17 plus years and multiple exits? Because he wasn't up to par. He just wasn't up to par. When we work with professionals, and we want things. When we ask for certain information, I need to provide it to you. My fiduciary is to you. I want to come back to you and tell you, I know exactly what the occupancy, I know exactly what the rent is, I know exactly what the issues are. And when my local partner cannot supply this to me, it causes friction. And so we're not afraid to roll up our sleeves and to take care of the project and to do what we need to do. But we'll always refer back to the market. I didn't cause this. The market caused this in Tampa, right? I didn't cause when we got into this project, was interest rate was 3.6. The interest rate was 9% at the height. or close to even over 9%. We were smart enough to buy insurance to keep our mortgage at 5.75. But you got to deal with the good, you got to deal with the bad. Preservation of capital, and that's essentially what we're doing. So, and that's really the bottom line. It's always keeping your fingers on the pulse. It's knowing how to deal with certain markets. Not always it's going to be rosy, but you got to do what you got to do, right? Gotta roll up your sleeve, and I got to say, my team has been amazing. It is amazing. Um, you know, and we're doing what we have to do.
Bravo, Joe. Thank you very much.
So with no other questions, I'm going to say that if you have interest in this one is income. It's quarterly distributions. You don't have to be accredited. It's $25,000 at a minimum. We've had a couple of instances of people invested a little bit less. We're looking for a short-term infusion of capital. It might be, you might exit by next year of April, or we might extend it one additional year. Meanwhile, you're getting your distributions, and your overall net return after everything, after all fees, is 14%. So if you have interest in this, we'd love to talk to you. Reach out to Laura, shoot an email, get on a phone, and she will send you the information. If you have any other questions, you want to get me on the phone, please do. And I want to really thank you all for joining us. This is a monthly conversation covering the markets, covering different assets, and talking about our portfolio. And hopefully, you'll bring your questions and we'll be able to have a beautiful dialogue. Anything you want to add, Laura?
No, thank you
Thank you,
so much,
Giselle.
everybody.
Appreciate that.
As I've been dropping in the chat, I have dropped in the deal room. I will just very, very quickly give it a little bit of a share here, just to show you all what it is that you are looking at. If you open up our deal room, very, very user friendly. You can submit your interest in here. It will take you through. It will show you and guide you through the documentation that we need you to complete. And again, obviously, we have more information within as well, relating to the full OM and the due diligence and everything that comes with it. So visit the link, email me, text me, whatever it is. We would love to have you participate. I have been getting some emails as this Zoom has been going on. So to thank you to everybody who has committed already, confirming your commitment at this stage. I will get back to you first thing tomorrow morning to make sure that you're supported on next steps. Alrighty, so again, on behalf of the entire team, thank you so much for joining us today. It's been a pleasure. And we look forward to hosting you on our next Zoom and wishing everybody a blessed rest of your day.
Thank you very much, everyone. Great experience.